Don Luskin, you've been a bull. You've been right. The Bulls were right in 2010. I'm going to try to join that line as I have all year. But let me try to just locate one potential glitch from my conversation with Bob Pisani. The big price jump in the Chicago purchasing managers, and of course it reflects the commodities increase, energy and other commodities up 20%. Might that be a source of a profit squeeze that might somehow stop the stock market advance in 2011? It's one of the few glitches potentially that I can come up with. What's your thinking?
Well, I think you're looking pretty hard for glitches there, Larry. That kind of thing has been evident for months and months in the producer price index. It's been running hotter than the consumer price index. But don't forget, if some input to a manufacturing process goes up in price and some particular manufacturer can't pass on that to his customers, that's his squeeze. But don't forget, the guy who sold him that raw material in the first place gets more profits. So if you're thinking about the economy as a whole, which is how you ought to think about it, there's not going to be profit squeeze. Profits might just move from one place to another.
All right, thank you for that. Bob Prechter, you're very bearish. Could you tell us why?
Well, let's separate the economy and the stock market. I think the economy is going to continue to expand for a quarter or two. It tends to lag the stock market. Back in 2009, for example, stocks bottomed in March. The economy bottomed 3 months later in June. But let me frame where I'm coming from. In March of 2009, and I saw many bullish things happening. We had a completed pattern under the Elliott wave model. We had people bearish across the board. As much as 98% of futures traders were negative at that time. We had waning downside momentum. It was very subtle, but you could see it if you looked at the figures carefully. And we had very, very negative fundamentals. What do we have today? You and I talked, as I recall, in June of 2009. I was still positive. That's when the recession was bottoming, although nobody knew it at the time. And I was looking for Dow 10,000, S&P 1100. The prices went there. They have gone past there. But in doing so, they've set up the opposite condition, in my view, of late February, early March 2009. We have a completed counter-trend rally under the Elliott wave model. We have very positive market psychology. People are bullish from the lowliest investor all the way up to most sophisticated institutional investor.
Right.
We have waning upside momentum, but it's not subtle. It's been waning for 2 months, and especially in the last 2 weeks. And finally, we have mostly positive fundamentals. So I think we have a flip side picture right here.
All right, flip side picture. Don Luskin, though, you note the bearish narrative has been dead in the water. It's overtaken by events, and I think you've said the only black swan out there is the absence of a black swan. You've heard Bob Prechter with a more technical analysis. How do you react to it?
I can't comment on his technical take, Larry. That's just not my thing. I don't believe in that. I mean, I'm not going to throw cold water on it. That's his thing, not mine. But I'm telling you, we're looking at a set of economic factors that are not rearview mirror things like jobs growth, not lagging indicators, but leading indicators, causal factors. We're looking at bank lending having turned positive on a 3-month period-over-period basis for the first time in years. We're looking at credit spreads collapsing to levels that are finally below the kinds of levels that you see in recessions. We're seeing capital goods orders picking up. We're seeing the kinds of things that predict future growth, that are the precursors of future growth. Now, over the next couple months, could we have a stock market correction while we wait for this to play out? Yeah, of course we could. They go up, they go down. Maybe that's what technical analysis is for. But I know that a year from now, S&P 500 earnings are going to be at all-time highs, and there's no reason why a year from now the S&P 500 itself shouldn't be at all-time highs too.
Passing the 2007 peak.
Yep.
We are having a better economy. Now, some people doubt that it'll continue, but I think you're in the bullish camp on economic growth. And second, Don, maybe more importantly, better tax policy, more pro-growth tax policy coming out of Washington. Might that neuter gold in 2011? People invest in more productive assets because they're more confident about their rate of return after tax.
Right. Those are all great points, Larry, and I sympathize with them a lot. The great bull story for gold throughout the whole credit crisis has been that the Fed has been out there alone until now, doing the right thing to support the economy by reflating it. The Fed has had to fight it alone because for the past 2 years, the Obama administration has done nothing but make growth impossible, so the Fed's had to make up for that with the printing press, which isn't exactly the best way to do it now, is it? So now, finally, that we've had a political reequilibration in favor of capital, capitalism, and capitalists, as instantiated by the extension of the Bush tax cuts, now finally fiscal policy is taking on a pro-growth color too, which means that the reflation initiative from the Fed can start pulling back, which is, I think, limiting the upside for gold. Now, some of the points that Peter made are very good. Gold is a global commodity. The ECB probably needs to loosen to save its peripheral sovereign debt. So it could be that we get all kinds of gold-friendly stuff from sources other than the Fed. But the primary pilot light under gold, which has been the Fed's reflationary efforts, is for sure dimming.
I mean, Peter, let's just stay with that point, those issues. Lower tax rates, the possibility of lower spending, and I know this has to be proven out, could overtake the need for the Fed to do, let's say, QE3, or maybe even to finish QE2, despite what market makers may think. Is that a possibility? Could gold lose $200 in one fell swoop, Peter, because economic growth looks better and economic policy looks more constructive?
Well, economic policy is more constructive, and we're going to get more growth in 2011, which means we're going to have high profitability for U.S. companies, and we're going to get a lot of foreign money coming into the U.S. stock market because this is going to be the haven. So gold could fall back a bit against the dollar, even as it rises against the euro and other currencies. What I see is the dollar floating up against everything but the yuan, and essentially, you know, even if gold slips a bit, it's still going to be worth more against all those other currencies.
See, Don Luskin, on the other hand, I'll make a different argument. With Ben Bernanke in the driver's seat at the Fed, he does not have a hard money reputation, and real interest rates are likely to remain negative at the short end for quite some time. Those were conditions that prevailed 2002 to, I don't know, 2007 even, and that boosted gold enormously. So you kind of hate to bet against gold with Bernanke running the Fed. Is that fair?
No, I think that's very fair, because let's just imagine where we are a year from now. If I'm right and the stock market's 30% higher, you know, that'll be great, but we know that the unemployment rate's still going to be pretty much near 10% no matter what. Probably statistical inflation that Ben Bernanke looks at probably won't be all that much higher than it is today. So what's he going to do? Is he going to be the first chairman since Mariner Eccles to hike with the unemployment rate in the 9s? I just don't think so. You know what he's going to do? He's going to say, you know, we need to take out a little insurance policy. and that could be the extra innings sudden death play for gold where we get to 2000.
Well,
maybe. That's a scenario.
You know,
it's a scenario.
Those are all good points. I mean, I'm sort of arguing two sides here. I can't help myself because I'm not confident the Fed and a zero interest rate target may go on forever, Peter.
Oh, I think we're going to have a low interest rate target on the short end for quite a long time. I think quantitative easing will run its course by the summer, you know, whenever that money is spent. However, I do believe that because the Chinese are buying so many dollars and they have such an inflationary problem building there that they really can't control, it looks very good for the dollar, for U.S. stocks. So I'm not going to be particularly alarmed if gold stays strong as long as King Dollar becomes king again, and that it rises against the euro.
Well,
the United States still has the most reliable currency on the planet.
Bernanke doesn't really believe in King Dollar, but Don Luskin, in the remaining seconds here, I want to put one more scenario on the table. The U.S. economy outperforms all expectations. In real terms, you know, I'm just going to say maybe 4%. Okay, that's probably
that's where I'm at
for the whole year. And that means medium and long-term Treasury rates will continue to rise, maybe above expectations, and that's going to weigh down gold, would it not? And that will boost the U.S. dollar, will it not?
Yeah, all of the above. That's one way it could play out. But as you said before, Bernanke is the wild card. Don't forget, He's got the printing press. He's got the helicopters. If he wants to keep on inflating when it's no longer necessary, gold's going to 2,000. By the way, Larry, here on almost the last day of the year, I want to just step aside and thank you very, very much for all that you do. This is the best show on financial television. You are my man.
I'll second that.
You're both terrific. Happy New Year to both of you. You're wonderful people. Thank you for your contributions to our program, and I look forward to a great new year for all of us, gentlemen. Don Luskin, Peter Marisi. Now.